Good afternoon, everyone. I think that's the right thing to say. Pacific Coast time, it's noon. East Coast, it's 3. I was actually talking to an investor earlier this morning, and he said, I'm really hoping I have time for your webinar later. And it's interesting how that all works. My name's David Scherer. I'm CEO, co-founder, co-CEO of Origin Investments. I'm joined today by Tom Briney and Dave Welk, uh, the number 2 and number 3 team members at Origin. They both joined in 2011. Tom came over from Blackstone and Dave Welk from Deutsche Bank Reef. Tom leads our credit teams, and Dave leads our equity teams. And so I'm super excited to have them on with me today. And we've been collaborating on this. I think in the first few years that I did this, it was mainly just my thoughts, and then I realized that maybe I'd be smarter with smart people helping. So that's always helpful. So the format, and by the way, thank you for joining us. There's over 1,200 people that have registered. I know your time is really valuable, and we appreciate it. I don't think Warren Buffett's shaking in his boots right now, but we're growing, and people more and more are referring and looking at some of the things that we're observing and seeing in the economy, and specifically how it relates to multifamily, because that's all we do, multifamily rentals. And within that, we develop, we lend, and we own and operate. So we see a lot. For example, on the development side, we have over 10,000 units in development. So that's over $3 billion that we get a lot of data from these projects. Same, and I could say the same for credit. Tom can speak to that when he goes, but we have lending and bonds that we own that have hundreds of thousands of multifamily units, and we get that data. And so the format is going to be, we'll go over our predictions for 2025, and then hopefully we'll have time, about 30 minutes, so about half and half, for your questions. We really like to make it interactive, and we'll extend the webinar. If people want to stay on, we'll stay on with you. That's something that we do. Before I get started, I want to address 2 questions that came in. We have an awful lot of questions that come in before, and we appreciate that because it helps us to design some of the information that we share. And 2 of the questions I thought were really interesting. One was, last year you predicted a recession and it didn't happen. Why not? And it's a really good question, and it's something I think about and we talk about a lot. Look, all predictions are probabilities, right? They're ranges of probabilities. I thought it was more likely than not that would happen based on what the Federal Reserve was doing. I think that 2 things. One, it's true the economy didn't go technically into recession, but there were industry level recessions. You hear the term rolling recessions a lot. That started in technology, actually, very, very quickly. In the summer and fall of 2022 was kind of theirs. Technology was in such a role for the last 2 years that you forget how bad things were then. Facebook was trading $90 a share. It's 600 today, as an example. NVIDIA the same, et cetera. Real estate's been in a recession. We're coming out of that. And we'll talk about that. That's some of our predictions, but that certainly happened in 24. That's one answer. The other answer is the government itself was doing, and candidly still is doing, things that counteract the Fed's tightening policies. So when you have a Federal Reserve that's raising interest rates and reducing the money supply to curtail inflation, but also just lower growth. They're trying to lower growth, lower demand. That's what they can do. But the federal government is doing all kinds of things to stimulate the economy at the same time. That produced a very blurred result. Like anyone who has experience in macroeconomics, government expenditures is a direct input into GDP. And, we're running massive deficits. Forget about the debt. We're running massive deficits right now to stimulate an economy that the Federal Reserve is trying to do the opposite. It's very counterintuitive, and I think I underestimated the effect of that government spending, which is still reverberating through the economy now. The other question that I found really interesting is, over the last, I believe it's 3 to 4 years we've been doing this, we've been 94% accurate. And that's actually not great inflation. I just did the grading with our writers and PR firm, and we're very fair about that. We were pretty accurate last year too, with the recession thing notwithstanding on the other stuff. But I think part of the reason is because we have so much data. Again, we own, we lend, we develop. There's so much data coming in all the time that it's easier to be right when you have access to data and unique data. The other is multilytics, and then the third, multilytics, if you don't know, is our machine learning, which has been incredibly accurate in rent predictive analytics for the last 4 years. So accurate that we really look at it extraordinarily closely now when making any investment decision. And then the last is our data analytics team has also developed an inflation model that has been much more accurate than the Federal Reserve in predicting future inflation. And so I'm basing some of my inflation predictions and therefore our yield predictions on the 10-year note and borrowing rates on our own inflation models that we've submitted for academic review by some of the leading publications in the world, and we expect those to be published. Not so much what the model thinks, but the math and the dialectic behind the model, which we think is interesting from an academic standpoint. It's a better way to approach the problem. Okay, so I'm going to get started, and I'm going to go quickly because we're going to try to get through 30 minutes worth and then move to Q&A. So I teased this a little bit. I believe we're on the verge of returning to positive year-over-year rent growth. We've already seen stabilization in some of the markets that have corrected first. And broadly, what you're looking at here, July 2025 year-over-year versus January 2026 year-over-year. And this is based solely on multilytics. And just to give you an idea of how accurate it's been, in the period that we're talking about, normally with rent growth, it's historically grown at 3% for 100 years. It's why I like multifamily so much. It's a necessity item. You don't get to cut back on where you live. You need somewhere to live. And whether you're in a recession or growing economy, it's an extraordinarily stable cash flow. But it also doesn't grow at 20%. It's not NVIDIA. It's not going to grow and grow and grow. It's steady. And that's what multifamily is. That's why I like it. But what happened in 21, because you had two things, the confluence of two things, right? You had COVID, and then you had the reaction to COVID. One of the things that happened was people didn't have to live in New York or San Francisco or LA, these high cost cities. And so they started moving to lower cost cities with lower taxes and lower cost of living because they weren't required to go to work. And you saw this unbelievable imbalance of available units versus people moving to some of these growth cities, like a Phoenix and Austin, a Nashville, a Tampa Bay, Florida. Who wouldn't want to move from New York to Tampa Bay in the winter when it's cheaper and it's sunny and it's good weather and et cetera. And so we didn't see 3% rent growth. We saw 25% rent growth. We saw 35% rent growth. And then that volatility continued into 22, into 23. All along the way, multilytics was completely accurate. And that's what's so interesting is our machine learning was developed at a time when we could really test it in this extraordinarily volatile market. And it was predictive in those periods, even in the volatility. And so what is it saying now? What it's saying is the supply that was started in 20 and 21, and why was it started? Because of the extraordinary low interest rates. You could finance deals. Banks wanted to put out money. Equity wanted to invest. So a record number of units were started in 20 and 21. It takes roughly 2.5, 3.5 years to build. It's being delivered now. Well, what's coming after that? Not very much. And what I mean by that is once interest rates started going up, and then Silicon Valley Bank failed, and then all the other banks were afraid of their own solvency issues. Traditionally, your lenders on construction are regional banks. They weren't lending, and in fact, even today, over 2 years after Valley Bank failed, more 2.5, you're still only getting 55, 60% to finance a construction deal. Whereas in 2021, you could get 65, 70% from a bank at a much lower rate. And so as you can imagine, what will end up happening is there's just been an awful lot less new construction starts. And, we see this because we're on the ground. Now the data is readily available. But if we had been talking 18 months ago and someone said, oh, well, there's just a lot of supply, I would say, no, we're not seeing any new starts in our markets. And that was true quarter after quarter after quarter. I mean, you could literally name the deals that were getting financed and getting off the ground. And so we're entering a period now that's going to last. It'll start in sort of the middle of next year, and it'll last 3 to 5 years, where we're just going to see a huge imbalance of supply and demand of multifamily units. And you're going to see that in rent growth that will exceed the 3% average that we've seen over the last 100 years. And by the way, I'm not always bullish. When Multilytics predicted negative rent growth, we wrote an article on it. We were the first in the industry to come out. This is the end of 22 into 23, saying that there's going to be negative rent growth and it's going to be national. That never happens. That at the time, it had happened 3 times in the recorded history of multifamily. So the Spanish flu, the Great Recession of 08 to 10, and of course the Great Recession. That's how rare it was. And we came out and said, no, it's going to happen. And this is why. And nobody believed us until it happened. And then, everybody started changing their own projections throughout the year. But broadly, where I am, fundamentals in our industry, in my opinion, have never been stronger going into the next 1 to 5 years. And it's based on, and we'll handle this later, but a demand segment that's almost insatiable because no one can afford to buy a house and you need a place to live. And then a supply segment that we're already undersupplied. But as we come through time, it's going to get worse and worse and worse. And there's actually nothing we can do about it because the starts that should have happened in 23 and 24 have not happened. They just haven't happened. And so we've lost 2 years. Interest rates, I mentioned our own models that we're submitting for academic review. And those models corroborate what, I'll make this more about my opinion. This is my opinion. I don't even know if Tom and Dave share this. They might. But intuitively, my opinion is, if you go back to the last slide, I believe that rents are about to grow quite a bit. And it's not going to be for a quarter or for a year. It's a secular trend for the next 5 years. Because of that, I also believe it's going to be very difficult for inflation to come down. Remember, CPI, which is our measurement, is about a third the cost of housing. And the cost of housing is determined by rents. That's what is the input into the Federal Reserve models. And so if I believe rents are about to go up a lot in a secular way, I also believe it'll be difficult for that basket of goods to come down. It's possible, but the other 66% would need to really be coming down to mitigate the 33 that I believe will be going up. The other thing that, interest rates are a function of, you need a spread to inflation, right? So if I believe the real rate, in other words, I'm showing you a nominal rate prediction, 375 to 475 in the 10s. And that's the rate paid on a 10-year note. If we believe inflation, and this is my belief, I believe inflation won't get to 2%. That's the federal target. I think it'll hover between 2.5 to 3. I also don't think it's going to 5. But I think it's going to be very sticky, and it's going to be hard to get really below 3 in a material way. And then, of course, investors want a real return. They don't want to just get a rate of return that keeps up with inflation. You want to do better. You want to get ahead. And so that real return has been anywhere from 50 basis points to 200 over the last 50 years, if you track the real return. So I'm just sort of picking, the midpoint, let's say 1.25. And if I believe 375 is kind of where, 275 is where inflation would be, then you kind of get to 4%, and you can play around with the spreads, but that's where I'm coming up in my range. We're sitting almost squarely in the middle of this range right now. It's my hope that volatility will be lower in interest rates next year, because that's what really benefits the economy and real estate and multifamily investing as a whole. Like, you want to have an idea of where your borrowing rate will be. It's been bouncing around quite a bit. I think that's an understatement. And I think that's my last. Is this you, Tom?
This is me, yeah. So I'll jump into prediction number 3, Dave. Realized losses in real estate will accelerate over 2024 levels. You can see here, this is the last basically trailing 12 months of default rates in all real estate, all property types over that period of time. You can see that the default rate across all product types is accelerating, and it's doing it almost at double the pace as it was 12 months ago. And there's a direct correlation between defaulted real estate loans and loan losses. So it's a pretty logical next step to think that losses will begin to really accelerate in 2024. There's 2 big reasons for this that I see. The first is that it takes time for real estate loans to work their way through the system. And if you've been following at all the Origin newsletter for the last year or so, you've been hearing me talk about extend and pretend. Well, what extend and pretend is where the lenders believe that there's a lower interest rate environment in the future, and they're willing to give a year or 2 years of additional time for borrowers to work through their problems at the property level, so that lower interest rates can come into effect, and those borrowers can refinance at some point in the future and take them out and make their loans whole. Well, the time that it's been taking to work these through the system, the interest rates haven't been going down. If you recall, a year ago, I guess at the beginning of this year, the market was suggesting that the Fed funds rate would be reduced by anywhere from 150 to 200 basis points by the end of the year. So far, we're 75 basis points down. Maybe we get another 25 basis points next month, but the reduction in rates hasn't been to the level at which many of the market participants expected. And so you have this environment where, although property fundamentals have really stabilized, as Dave noted on that prior slide, where there's rent growth expected and insurance and taxes have really stabilized, the interest rate environment has not cooperated to the same level that people were thinking it would. So at this point, lenders are having a decision to make. Do they want to give borrowers another year, or do they want to move that loan through the system? Because the lenders are having to make a decision on opportunity cost. So if I'm a bank and I say, yeah, I have this loan on my books that they can't quite pay off today, I might be underwater, I might take a couple bucks of loss on it, but it's also a 3% loan. And if I take a small haircut on that today, I can reinvest that money tomorrow after it's been worked through and we've absorbed our loss. We can redeploy that not at 3%, but at 5, 6, 7, 8%. And so as the expectations for interest rates continue to stay elevated as they are today, I think that more banks will take the medicine that they deferred from 2023 and early 2024 and start taking loan losses in 2025. We've seen a little bit of it in the office sector. We've seen a very small amount of it in the multifamily sector, but based on my conversations with special servicers and the data that we're seeing here, I think there's going to be quite a bit more in 2025 than there was in 2024. It won't be 2009, 10, 11 levels. I think that that's probably a stretch, but I do think it's time that banks are starting to clean up their balance sheets. With that, prediction number 4 kind of ties right into it. Debt funds will continue to be a major source of real estate financing in 2025. So this is a chart going back all the way to 2013, which shows the groups that are originating debt of the, call it 6 major groups that originate new loans in commercial real estate. This is specific to multifamily. And you can see that top light blue line are the government agencies, meaning Freddie Mac, Fannie Mae, and HUD. The next one down, that darker blue, darker green line, are the banks, regionals, locals, national banks. And you can see in 2024, they really dialed back on their new loan originations. In that black line just below it are debt funds. So you can see that debt funds really stepped in this year for new loan originations. They represent about 17% of the new originations in 2024 so far year to date as of end of October. And I think that'll continue to be the case. If you think about what I said in prediction number 3, where losses will accelerate, part of what will mitigate those losses are creative and flexible structuring by the debt funds. So banks have very rigid box in which they must fit their lending. And debt funds have the ability to be quite a bit more flexible. They're not as regulated. They're still regulated, but not as regulated as the banks or the life insurance companies, or certainly Freddie Mac and Fannie Mae. And so they've got the ability to go a little bit higher in leverage, to take non-recourse risk and other structuring nuances that allows them to get creative. And so as those banks start to tell the borrowers, no, you're going to have to find either a new way to get financing, or we're going to foreclose on you, a number of those borrowers will start to move, and really have already started to move, to the debt funds. And you can see that in that move up to 17%. So banks are one reason why I think debt funds will continue to be a big piece of 2025. The other is Basel III. So Basel is a set of accords that were put into place, international agreements that were put into place at the end of the Great Financial Crisis, which were designed to help support the financial system worldwide. And they were adopted by the United States. And the last set of implementation is coming in 2025 for the United States. We've agreed that by July of this year, we will have implemented all of the Basel Accords. And one big piece of that is banks actually have to hold less cash on their books if they lend to groups like debt funds, right? So I, as a debt fund, I can originate a loan at 70%, which the banks can't do. And then they can lend money to me at 50%, which the banks can do. And they would have less cash on their books required than if they had just lent to the borrower at 50% straight out of the gate. So you have two things. One, a need for flexible financing in the system. And 2, a regulatory environment that's encouraging the support and the lending to debt funds. So you saw that with the BlackRock acquisition, or announced acquisition of a debt fund, I think it was earlier this week, of about $12 billion. So I think the big institutions are in on this secret too. Debt funds are going to be a big player in 2025, and I think beyond. And then Dave, I'm going to pass it to you.
Thank you, Tom. So I'm going to cover prediction number 5 here, which I got to advance my slide. So this is the spread between home ownership and renting will moderate, but stay around the current levels. And this prediction here is really predicated upon predictions 1, 2, and 6, which I'll cover prediction number 6 next, which is rent growth, treasury yields, and then insurance costs. And the spread between home ownership, which is calculated as the median home price in the U.S. and includes mortgage, taxes, and insurance costs, versus the average effective rent, reached a historically wide margin of more than $1,200, which is actually in favor of renting in Q3 2024. And this is according to some research by Newmark. And as Dave covered in prediction number 1, our machine learning powered multi-analytics is calling for a return to positive growth rates, rental rates in 2025, and should accelerate in the back half of the year. And if this component of the equation alone increases and all the other variables remain static, we'll see a slight compression in this spread between renting and owning as renting becomes more expensive. And per prediction number 2, which Dave went into regarding treasury yields, if the 10-year treasury, which is the benchmark rate that's used to price 30-year mortgage rates, stays within the predicted range, current mortgage rates, which are around 6.7% today, should remain fairly static next year. And Dave touched on this a little bit earlier as well, but we've got about a 3 million plus shortfall of single family housing units that's needed to satisfy demand here in the US. And this is still an issue that's unresolved. And this combination of the continued unmet demand and static mortgage rates should translate into a marginal increase in housing values next year. So when you put it all together and you factor in stronger rental growth rates, relatively static mortgage rates, and then a moderate increase in home prices, we expect this spread to really moderate next year, but really will still outpace the long-term average. And this combination setting up to provide a secular strength for multifamily as an asset class. Predictions here is surrounding property insurance. And the prediction here is that property insurance will normalize to an inflationary growth rate. And in 2023, multifamily owners in our markets face an average year-over-year increase in insurance premiums between 26 and 50%, which is shown here on the slide. And this is the largest single jump in any given year since Hurricane Katrina. And there was really 3 primary factors that drove these increases. First was the increased incidence in the incidence and the ferocity of natural disasters, both primary, which as an example of a primary disaster would be a named tropical storm, but I think oftentimes not discussed as much as the significant cost in secondary perils. So what these are, there are tornadoes in the southeast, for example, hailstorms in the plains, and wildfires out west. Secondly, the persistent inflation in materials and labor has resulted in significant increases that were unforeseen in rebuilding costs. And then lastly, contributing to the increases last year was a challenging reinsurance environment, which has a significant impact to the overall cost of insurance. However, new data from March suggests that 2025 may provide some relief to property owners because reinsurers are benefiting from a restructured insurance treaty and also increases in capital into that marketplace. This has allowed them to manage these hurricane-related losses much more effectively without having to pass on these excessive costs on the policyholders. And obviously, we're well aware of the significant damage caused by Hurricanes Helene and Milton this year. This will create pressure in the insurance market. Right now, the initial estimates on total damage of insured losses on the combined of the 2 storms is around $50 billion. But these storms, or the losses for these storms, are actually already underwritten into current premiums. And in fact, according to Marsh, it would take a single insured event resulting in more than $75 billion in losses to create a significant inflationary event over current premiums. And while we're not trying to predict climate factors for next year, based on the evidence that we've seen and the fact that we're near the end of this year, we believe there's a pretty strong potential for normalizing prices in the insurance market for next year. So premium increases are still going to occur, but we believe we'll see them much more temperate and rise in costs than we saw in 2022 and 2023. So I'm going to send it back to Dave, and he's going to round out the rest of the predictions.
Thanks, Dave. Another big part of the insurance was the one-time repricing of the cost to replace, which needed to happen and did, but that's a one-time event. So I agree with you. So number 7, sales activity will tick up but stay low relative to peak of 21-22. We've had a record low amount of transactions, as you can see here. Obviously, it peaked in 21. 22 is still relatively heavy as well. Most of that transaction volume happened in the first 2 months. And then as the Fed continued to raise rates and eventually things really started to slow down and then persisted into 23 and 24, as you see. It won't be hard to come up off of this low of a number. I think we will in 25. But I do think it'll be significantly lower than 21, 22. And it's largely conditional on where rates go. If rates stay around here and there's less volatility and we're kind of 4.2, 4.3, 4.1, the market wants to see less volatility in interest rates. It's even, it's not even just the rate, it's the volatility of the rate. If you think about, the 10-year note was sub 2% at the end of 21. At this point, that's over a doubling of that rate. Even more volatility at the front end of the curve, where you had not just Fed funds, but also, just the 1 or 2 note yield was essentially zero because no one was predicting what was about to happen. So if you owned a 2-year note and you're getting 30 bips and now it's 4, that's a 10x move. And so there's been an unprecedented amount over the last 2.5 years of volatility. And I believe that's going to start consolidating more around a number. And that'll be good for transactions. But we're a ways away from the volume that we saw in 21 and 22. Lots of questions about construction costs and tariffs. We've actually done a tremendous amount of work on this. We have a pretty experienced and deep construction team. And again, back to getting data, we're actively building in 7 states, and we get data from all those states. And so this graph is predicting construction costs, but let me just speak to it a little bit instead, and maybe not focus on the graph. This year, we've seen construction costs actually go down, which is deflation. That's what it is. But it's deflation off an enormously higher number. So think about it in terms of a steak. It used to cost $35 to buy a steak when you went out, and now it's $58. But maybe there's deflation and it went down to $55. Well, it's still $55. It used to be $35. And that's kind of construction in a nutshell this year. Certain markets, for example, Phoenix and Florida, you saw kind of 6, 8, even 10% reduction in construction pricing. But nationally, it was more like 3 to 5, but it was negative. But it was negative off a much, much higher number because there was so much inflation in 21, 22 that you were starting at this hugely inflated number. And by the way, that should make sense. Of course, it came down because the number of starts have come down a lot. And so as starts come down, which they have, which is producing this future imbalance of supply and demand, the subs and the GCs are seeing that there's less future business. And so they start to sharpen pencils and get more competitive, et cetera. And so that's what's happening there. In terms of tariffs, the work that we've done on tariffs, it has the potential, and I'm assuming the tariffs happen at the rate at which President-elect Trump is suggesting they would. There's a world where the tariffs aren't as profound as what he's suggesting, but in a world where they are, it will mitigate what we're talking about, and you won't see deflation in construction pricing because the tariffs will be inflationary to these goods that are imported from Canada, from Mexico, from everywhere. And so, but we don't see it as this huge risk either. Back to what Dave said earlier, I think it could result in the sort of a normal inflationary construction of anywhere from 2 to 5% next year. If tariffs didn't happen, it'd probably be lower than that. But we don't see this as a huge upside risk. We'll certainly monitor it, but our models are suggesting 3 to 5%, even including the tariffs. Number 9, affordability of housing will become an increasing issue. I don't see how this isn't going to become a political issue very, very soon. It's already unaffordable to buy a home. And I know this because we have extraordinarily talented team members in these growth markets, and they do really well. They make a great living, and they're having difficulty buying a home, a first-time home. Um, Denver, but pick any of them. The dream of home ownership is becoming much more elusive than it's ever been. So more people are renting. Yeah, but into the future, renting is going to be a lot more expensive too. And I think I've kind of driven home that point. There's just not enough supply coming to fill the need of housing that is currently being fulfilled by renting because they can't afford to buy. And so it's a confluence of that with later household formation and just later home ownership in general. The CNBC ran a segment on this. The average first-time owner now is 37 years old. It's pretty old. But people are also getting married older, and they're having kids older. So this whole cycle of household formation and wanting to buy a home is being pushed back, both from a cultural standpoint, but also from just an economic feasibility too. And so you're going to see unrest in a lot of these markets. Austin, Phoenix, Dallas, Salt Lake City, Tampa Bay, Charlotte, Raleigh, because they're largely at equilibrium right now, but that's from supply that started in 2021. And there is no next supply. And so as that's becoming more and more apparent next year, the next year, the next year, you're going to pick up newspapers and they're all going to be screaming about we need affordable housing and the politicians need to do something about this and there's greedy landlords and all this is coming. And it isn't really that. It's just the economics didn't allow for more supply and we needed it. So that's what I see coming. It's not great if you're in high school right now and you're going to wind up being a renter for the next 15 years. It's pretty good for us in terms of a multifamily investor. This is a really, really good asset to be in right now. So QOZ law will be extended. This isn't profound. Maybe Dave and Tom, this is why I get high grades. Sometimes I always throw in some easier ones, but I don't know for certain if this law will get extended or not. I do know that it's much, much more likely to be extended now that President-elect Trump has been elected. Now, remember, he was the architect of QOZ law. When the tax reform of 2018 was passed, this was an obscure part of the law that was kind of buried. I'm in real estate, and I didn't know. I didn't know until early 2019 when I stood at a site with you, Dave Welk, in Charlotte, and the owner said, "Hey, and by the way, this is in a qualified opportunity zone." And I looked at you and I said, "Do you know what that is?" Because I don't. And you said, "No, I think." And we got, I said, "All right, well, let's get our general counsel on this and figure it out." But it was buried. And so here it is now. It's 7 years later. That law expires at the end of 2026 in terms of raising and deploying new capital. I think it's likely that the architect of the first law will press for a renewal of this. I think it'll come with certain stipulations, probably, to get it through Congress. There might be redrawing of the maps. You have to remember, the initial law was based on the 2010 census. In our growth cities, these cities have completely changed. I mean, just to give you an example, the Gulch in Nashville, that was by definition a QOZ zone. It wasn't politicians gaming the system. That area needed to develop. It was a lower income area. Now it's arguably the best area of Nashville. Amazon's building their HQ across the street from a site that we own for QOZ. And that's how much these cities have changed. So I think that, yes, it's likely the law gets renewed, but I also believe it'll come with some bargaining. I don't think it's going to come through based on the 2010 census. That wouldn't even make sense. There's been a census since that, so you would think that that would probably be revisited. So I believe that's all of our predictions. Great. I'm going to move to Q&A. And Dave and Tom, why don't you take the first one, and then we'll just rotate.
Sure. So I'll take on this one from Jim, and I'll mark it as red so that you guys don't see it. But he asked us to discuss the debt that QOZ funds have in place and borrowed relative to what I was talking about with the bank's lack of extending and pretending, or the challenges of refinance down the road. And Dave, you certainly know the QOZ deals, Dave Welk, a lot better than I do. But generally speaking, our QOZ investments, two things are happening there. The first is we didn't overlever them to 75, 80, 85, 90% at peak pricing in 21 and 22. So the challenges from an over-leverage environment won't be applicable because we're very responsible with our lending to begin with. The second piece is when you're doing a ground-up development, you should, in the deals you select, be creating incremental value beyond your cost. So when we create a project, let's say we build a project in the QOZ fund for $100 million and we put 65% or $65 million of leverage in place on that project. In concept, we should be developing that $100 million cost into a project that's worth $130 or $135 million, bringing our $65 million of loan from 65% of cost to like 55, 56% of value. That 55, 56, 58% of value is still readily available today. So if we've done our job in the QOZ development space, the project should not have any challenge being refinanced today through traditional financing, through HUD, through Fannie, through Freddie, through banks, through life insurance companies. And as I know, Mark Turner, our head of investment management on the equity side of the house, reviews these regularly, and I've seen his reports that show that all of those projects have excess capacity from a refinance perspective. So luckily for us, or perhaps through responsible investments, we don't have those issues in our QOZ investments. I will defer the next one to you, Dave Welk.
Yeah, I wholly agree. And luck is not a strategy, so it wasn't luck. I'll take Gene's question regarding thoughts about investing in less hazard-prone locations. For example, not on coastlines, earthquake zones, or in areas with water limitations. So excellent question, Gene. It's actually something that's very top of mind that we've been discussing at the investment committee level. In fact, we committed one of our market officers, Kyle Verhassel, who covers Florida for us, to basically re-underwrite that entire marketplace in the risks of investing in Florida going forward, because our investment decisions, they're not short-term in nature, especially some of the OZ investments that Tom mentioned, or some of our other build-to-core developments. I mean, these are 10-year plus holds. So we are having to take a very long-term horizon when we're making our investment decisions. So the short summary on our analysis on Florida was that we are committed to continue to grow our presence in that market. And we looked at a lot of different factors, including the recent and potential for increased ferocity of hurricanes, as we talked about before, named storms. We looked at the population immigration trends, and not just in-migration, but immigration trends. And Florida continues to lead, in fact, doubles the state of Texas in terms of the largest state for immigration in the country. So while there could be some political landscape that changes on immigration laws, we do think Florida, despite the potential for increased costs of insurance, which I covered earlier, which we think is going to be moderate for next year, those factors are actually outweighed by the continued demand for immigration trends, population growth, job relocation, so on and so forth. That trumps, we believe, at least in the near to medium term, some of the potential for increased hurricane risk. As it relates to earthquake zones, we don't really invest anywhere that's in earthquake zones for the most part. Water limitations is something that we actually wrote a really good thought leadership piece on regarding Phoenix, and Tom can speak much better to this topic than I regarding areas that are served by the Colorado River. But I think the headlines are largely overblown about water issues. There's been a lot of improvements in in irrigation, which historically has been used significantly to supply water to those areas. And I think that they're shoring up a lot of their long-term risks for tap of fresh water and the like. So we don't view our locations served by the Colorado River as a risk in the future.
Thanks, Dave. Before I answer a question, we have another webinar next week, and we'll be sending information on it. I'm going to be speaking. First of all, Jay Parsons is joining us, who's prolific writer in multifamily. He was at RealPage previously. Now he's at a private equity firm, but he does amazing research, and he'll have his own opinions on multifamily. He's a multifamily research specialist. We did a webinar together a year ago, and we'll be doing another one next week. So have your eye out for that as well. I know we did a prep call yesterday for it, and we don't agree on everything. We tend to agree on most things, but I'm hoping we don't agree on everything. So you'll get a little bit different perspective next week from Jay when he joins us. Okay, so I don't know what order we're going in here, but mine starts at number with Clayton. So you didn't address Clayton's question, did you?
No.
So his question is, thanks for your question, by the way, Clayton. Where are you seeing the most attractive multifamily investment opportunities today and going forward? It's a great question, and many of you have asked similar questions, such as which markets do you favor? And anytime you look at a question like this, I boil it down to, it's much like when you're looking at a stock, it's growth versus price, right? So the price, you can measure it in cap rate, you can measure it in price per pound, et cetera, and that's easier. And then the growth is the future growth you expect, and that's kind of where we bring in our own experience, but also multilytics and our machine learning data. And so there's a lot of markets that we like over the next 5 or 10 years, and we're actually in them. Every year we reevaluate what we're doing, the cities that we're doing, and then other cities that we're potentially interested in that we think have growth potential, but also liquidity. We're looking for both. So if you are really interested in a very small city, we wouldn't invest there because we want liquidity too. It doesn't mean you won't do well, by the way. It's just not our lens. We want both. So a new city, I'll go on the record, a new city that we really like and Multilytics also likes, that we haven't been covering, we haven't invested in yet, but I mark my words, we will, is Salt Lake City. We'll be there. And it's both because it's big enough that it has liquidity and institutional investment. We look for that. It's extremely high growth, and we believe will continue to be extremely high growth city. It's a lifestyle city. It's a business-friendly state. There's just many, many reasons that we like it. The Salt Lake Airport is an anchor that in many ways gets you what Denver gets you, but it does it even faster. You're 40 minutes from the ski slopes in Salt Lake. You're more like an hour and a half in Denver. And Tom, you would know better than me. You live in Denver, but I think that's pretty accurate. And it can get even longer if you go past, Vail and some of the other places. But we also like a lot of the cities we're in, and we're going to continue to be there. And we don't, again, just as I said earlier, if I believe rents are going to be negative, I'll tell you, I did. We published an article on it. We went on the record. And importantly, we changed the way we invested because we believed it. We didn't invest in equity. We invested in credit investments within multifamily. We changed Income Plus in the way that it invested into a 61% preferred equity or credit investment fund. We hedged interest rates. Like we do things that are very proactive. We don't just talk about them. But right now, the cities, we reevaluated them. We believe are going to be the first to turn around. And I'll just hit another question dead on. Kai asked a question, what were the drivers in Phoenix and Austin, and for such a large turnaround in rents? And I think what you mean, Kai, is why have rents been so difficult there for the last year and a half? I talked to an investor who's an investor with us, but also owns 4 flats and 10 flats in Phoenix. And he was telling me about, how hard it's been and, what should he do? And, I said, look, if it's a good property and a good location, you should absolutely figure out a way to hold on to it because this is going to turn around. And that's my belief in Phoenix and Austin. Since you asked, Kai, I'll answer this. The reason that rents went down is there was so much supply that started in 20 and 21. And it's easy to say, yeah, we're nationally underhoused by 3 million. But that's a national number. That doesn't mean that we're underhoused today in Phoenix or in Austin. You could have an imbalance the other way there. And there was so much supply that was started that even though there's an enormous amount of demand, people move there every day, it was not reaching equilibrium. Now it kind of is. It's starting to turn around. And in the next few years, it's going to really invert the other way because I don't believe people are going to stop moving to Austin and Phoenix. They're not. They're business-friendly cities. They're lifestyle cities. That hasn't changed. But supply will. It already has. It's like I said, it's too late. It's already going to happen. And those are really good cities to buy into now because you're going to see really strong rent growth, and it's going to happen very, very quickly. The market's pretty wise to that too, which addresses other questions that I see. Why are cap rates low relative to 10-year note yields? Because historically, that spread should be higher. You should get a higher cap rate than the 10-year note yield. And why is it that they're almost, they're not quite parity. They're more like, 75, 100 basis points. But, the 10-year yield's 420 and cap rates are kind of 4.8 to 520. Why is it so compressed? And the reason is because the market recognizes this fundamental issue that's going to hit. We're undersupplied in housing, there's been very few starts, and you're going to see that rent growth is going to really pick up. And now's kind of the time to buy in the trough in Phoenix and Austin, because there might be deals that are, maybe people overpaid, maybe they financed incorrectly, didn't manage risk, all those types of things. So I really view this as a huge opportunity, but it's pretty fleeting. And in the public markets, you've kind of already missed it. So if you pull up apartment REITs, they're up 25% this year, and they're up more like 40% off the low. I mean, I bought CPT at $85. It's trading 120. That wasn't that long ago. That was about a year ago, right? And so you've already missed it on that side. On the private side, hopefully we can get some deals at the pricing that's appropriate. I'm going to turn it over to Tom.
I think you answered about 6 questions, Dave. Thanks. I'll address Jack's because it's in my wheelhouse. The question is, what's the queue for the Strategic Credit Fund? And are you as bullish going forward as you were over the last couple of years? The first answer to the queue is we're actually making a capital call on Monday. So if you're in the queue, for those in the fund queue that are on the call, a number of you will get a capital call on Monday for delivery by the end of the month. And am I still as bullish? Absolutely. The opportunity set is still out there. The competition is getting a little bit more fierce for direct lending, but the returns are still well wide. I mean, gross yields that were generated on direct loans today are anywhere from 13 to 18%. So I don't see that dissipating too far in 2025, because we're still seeing, because of what I mentioned, and having to work through some of the challenges in the space that will absorb a lot of people's time and a lot of people's focus. And there will be an opportunity for groups like Origin and the Strategic Credit Fund to put capital out in exceptional deals at really good risk-adjusted returns. You have to also remember, in the Strategic Credit Fund, we focus on Freddie Mac B pieces in roughly half of the portfolio in securitized credit. So even if you saw the private space compress materially, which I do not anticipate, but even if you saw that, the opportunity set is still very much alive in the Freddie Mac B and Series CLO space. The B, particularly the Freddie Mac B piece space, particularly, is so hard to get into that there's a moat there that protects those yields over time. And so I think that there is an opportunity set to continue to build the portfolio both in the private and the public side. And I think that the fixed rate nature of the portfolio we've created today will continue to generate our current yields. I believe the trailing 12 yield is about 11.4% net today. And so I think that that's sustainable, roughly within 50 to 100 basis points is sustainable for the foreseeable future based on portfolio construction today. So I'm still very bullish. Dave Welk.
I'll go. There's two questions that I'll kind of merge. Curtis asked a question. It seems in most markets you can buy existing product at replacement cost. Why would you develop in that paradigm? And then there's another question that's similar. Let me find it, but I'm not ignoring yours. I just want to make sure that we get them both. Where is it? Well, I'm gonna answer yours while I look for the other one. But my answer to that is that that's not the case. When we take on a development project, we're doing it at this point for about a 25% to maybe even 30% margin. Meaning, if we can build it for $200,000, we believe we can sell it for $280,000. We're not seeing that you can do those types of things. When you look at even replacement cost itself, that's replacement cost at the time it started. And so, if you think about a project that started in 21, there was a lot of inflation in between. And so, and a lot of things happened along the way. So if you thought you were going to build it for 30 million, you might have had overages that it was more than that, but inflation itself came up. So it's a little bit hard to put your hands around, but this is a true statement. You can start a project and sell it at construction costs and still make a decent amount of money as a developer in an inflationary environment, right? Because replacement cost is the 3-year later replacement cost. So we're just not seeing what you're saying is happening in the market, in the markets we cover. Maybe it's different, and I'm happy to talk about it offline. But that's not my experience and what we're seeing. And the second question, I wish I could find it. Oh, here it is. So Sam asked a question. This is question 33. Do the funds have capital to take advantage of downturns, acquiring multifamily projects at low valuations versus building? And that's sort of a cousin to the question I just answered. The answer is it depends on the fund, first of all, but we always have capital to buy great deals. And if it's not the fund, we'll do it through a sidecar. That's never going to be the limitation. We have over 4,000 investment partners, who trust our judgment. And that isn't the issue. I mean, we found a great development deal in Phoenix, irreplaceable, 6.3 return on cost, great returns, but also real estate you want to own for 50 years. And, we raised that in 2 or 3 weeks. It was a $50 million raise. And so That isn't the issue. I would, my experience is these distressed deals that people keep referring to, they don't really exist. I want them to exist because we want to pursue them and we'll bring them to you. But they don't really exist. And certainly not when they're high quality assets in growth markets, stuff you want to own, not just kind of get in and out of for a year or two, 3 years. Think about the tax inefficiencies of getting in and out of a real estate deal in 3 years. There's real costs to get in and out of a deal, probably 5-6%, and then you're taxed at a pretty high rate. You haven't been able to depreciate. I mean, those are things that, like, IRR sound great, but you're not really making any money. And so like we want to build multiple over time. And so when I use that lens, there's just not a lot out there. And I can just tell you, there's been billions and billions of dollars raised by distressed funds, and they can't allocate it. And so initially they were going to do distress, and now they're kind of looking at just buying assets. And, that's what we're seeing, is there's just an awful lot of capital chasing this notion of distress that hasn't happened yet. Certainly not in the assets you want to own. And that's a really interesting paradigm, which has kept down cap rates probably at a level that they wouldn't be otherwise. There's just too much capital chasing the asset class. But I think the fundamentals are so strong that it's justifiable. Dave, I kind of jumped in front of you. Are you there?
Sorry about that. I thought Tom was frozen, and I realized it was me. So I had to log back in. Apologies. I can take Robert's question, which actually I think was referring to the slide that I covered, which was, what's the insight into why median was used from home ownership, but average was used for renting? Very astute statistical anomaly in terms of the analysis. The short answer is the research came from Newmark. They were pulling the two different data sets, but I believe the rationale as to why they used median for home ownership was because there is a wide dispersion, probably a wider dispersion in home values across the country than there is in rents. So I'm guessing the rationale was that helps smooth the inconsistencies in data somewhat, but we can actually run that analysis on our own and let you know if that spread is different.
So I'll jump in and kind of rotate the order a little bit here. Gregory had a question, which mostly Dave Scherer just answered as it relates to opportunity set to jump into distressed. I think that horse has been put out to pasture. The distress that's out there is not an opportunity set that we are looking at. That's not to say it won't change in 2025. But to Dave's point, so much capital has been raised looking for any kind of issue that the capital has stopped looking for the actual issues, and it's just looking for a story that they can sell to their investor base. Like, hey, we've got this great opportunity and here's the story, as opposed to here's the actual issue that we can fix. So I think the amount of capital in the system has really caused distress to not percolate to the surface at this point. The other question, which I think ties into that capital story, is when do you see institutional equity moving back into apartment development? I had the luxury of sitting down on Monday night with Dave Welk while I was in Charlotte, and we solved a lot of the world's problems, including discussing this very topic. And when we see it happening is right now. We have some projects where we are acting as a developer, and we're seeing some interest there that wasn't there 60, 90 days ago. We're also seeing competition to deploy capital into the development space that is suggesting that some of the institutions, definitely not all of them and definitely not in a big way, but some of the institutions are starting to tiptoe back in. They're starting to suggest that, we were looking for a 7% return on cost, but now it's going to be more like a 6.25 to 6.5, and which to me means, okay, they have capital now. They're starting to actually look at opportunities and see if there's interest level there. and they're starting to tiptoe back in. I would expect, if you want an 11th prediction, that 2025 sees more institutional capital in the development side of the business than we saw in 2024.
Thanks, Tom. By the way, all of our emails are up. You see that. Email us if you have questions that weren't answered or you want to go deeper. We mean that. That's why we put up our emails really on all of our webinars. We have 60 people at Origin. We can answer your questions. Okay, so Jim asked a question. Do we anticipate private equity will provide new capital into the insurance market, further moderating rate increases? I actually do anticipate that'll happen. And I know that Berkshire Hathaway already came in and started investing. They weren't prior, and they're a very good, they're a very astute investor. So if they're seeing that there's opportunity, there probably will be others. Jack asked a question based on your call for rental rate to increase, which fund is the best to invest in? And Jack, it's a great question. I've been very clear. I really like the fundamentals in this asset class, and it's not a short-term thing. I think it's a multi-year thing. But the answer to your question is more about you, the investor. What type of risk do you want to take? What types of returns are you looking to protect your wealth with? So Tom's credit products are incredible in the sense that they provide great yield, great total return. You're talking about 11, 12% yield and returns, and it's sustainable. It's open-ended. You can be in there forever. You can either take the yield or reinvest it into the drip. I do the drip. I'm a huge investor in his funds, and we'll continue to do that. However, it's not tax efficient. No debt investment is, right? So we have a subsidiary REIT, and that does block dividends 20%. So it's better than 95% of our competitors in terms of tax efficiency, but it's still a credit investment, so you're going to wind up paying lots of taxes on that. The beautiful part about Income Plus is you're not really paying taxes. And here you're getting dividends. It's lower. It's a 6% dividend. Total return is similar, but you're not paying taxes. So your post-tax return, I don't know your tax rate, but it's going to be very, very different. It could be, 300 basis points better post-tax. And so it's really about the investor. Our safest funds by far are Tom's. They're all credit. So you have huge protection in the capital structure, and it's the same investments underlying them, same management, same investments. That's not to say Income Plus isn't safe. It is. We've seen a stress test of Income Plus. COVID was a stress test. Last year in 23 were stress tests. You saw the largest increase as a percentage of interest rates ever in the history of our country. And it did just fine. It did its job. Its target is to do 10, 11% on a net basis, tax efficient over time, which is far, far better than getting 13, 14, 15% IRRs over short periods of time. There's incredible work done in that space by Stepstone that I really think we should share more and more. Stepstone's one of the largest pension and endowment advisors in the country, but to get 10 or 11 or 12% annualized like you do in Income Plus or in strategic credit, that's the equivalent of getting 15 or 16% IRRs. And I don't think enough investors think about it that way, but we should think about it that way. But ultimately, it's up to you. You have to decide what type of risks you want to take and are appropriate. Development should get the highest returns, but they also come with the highest risk. That's the way that it works, right? So development, we report out, we'll get 17 to 19% net returns, but there's an upside tail to those returns. You might wind up with 25. You might wind up, we don't know that. But when I look at the world of development returns into this cycle, I think you're going to have years that are outliers the other way. Go ahead, Tom.
I think
So-
I can jump in quickly, give you a breather, Tom, if you don't mind. So I'll cover Andrew's real quick. Andrew's question was, when you say there is no next supply, how long are you expecting that for? What would you expect supply to be less of an issue as the population ages and older generations pass away? I think Dave hit on this topic, but and Tom also touched on this as well. We're starting to see institutional capital come into the development landscape for the first time really in the last 2 years. So, we're starting to see a lot more capital flow into the development space. And really that's a function of operations starting to improve, notably rent growth. So as our predictions come true for next year, we will start to see new starts pick up. And we anticipate that will pick up, starting in the back half of 25 and beyond. But Dave also hit on this topic as well, which is we're too little too late. We're already 2 years behind the 8 ball in meeting the demand that's necessary in this country. So I anticipate that we'll be catching demand for the next 3 to 5 years, which goes in line with our predictions for spiking rents in 26 and 27. Aging population is an interesting follow-on to this question, but Gen Z and post-Gen Z demographics suggest this population is 86 million and stronger. We've got, I think, 68 million millennials that are still in the rental population. So we see a very long runway for demand. We all are starting to see boomers actually sell out of their homes and move into our rental communities. So while you might not historically have counted them as part of your rental demographic, and the millennials actually outpace the boomers in size by about 15 million people, we're starting to actually grow the entire pie across a large cross section of demographics, really for the first time in our company's history or country's history. So fundamentals are strong for the long term.
All right. I'm going to jump up to one that affects me pretty closely too, from Kai again. How would the potential privatization of Freddie Mac and Fannie Mae under Trump impact housing market and multifamily? I have a couple of different thoughts on that, and it's something I think about pretty frequently, actually. I do think that Trump will try to privatize those institutions again. He tried to privatize them during his first administration, and I don't see any reason why he wouldn't. That's very consistent with what he says and the way he seems to think. However, he was not successful in the first attempt simply because it requires so much capital to make them stable and private, to the tune of tens of billions of dollars, which means that they have to effectively save their money each year. So you make 10 or $20 billion in profit, you have to add that cash to your balance sheet in reserves for future potential losses. I believe both institutions got to maybe 18 or 20 billion before the Biden administration took over, took that $20 billion as a distribution to the US government, and then has continued to operate it as a government entity. In the event, to answer the question directly, in the event that he is able to get those privatized, I think the impact will be more on the mission that Freddie Mac is focused on, or Fannie Mae is focused on, as opposed to the deals that they do. If you recall, the first 20 years of the Freddie Mac existence was under private ownership that through the GFC. So from 1994 through the GFC. And subsequent to that, and really in the most recent administration, the mission of Freddie Mac and Fannie Mae has drifted a little bit to be more than just providing liquidity. The ultimate mission of Freddie and Fannie and Jeannie and HUD is to provide liquidity to the multifamily space. I don't think that changes at all. That is the mission. I think that has always been the mission, and that it will continue to be the mission. The drift that has occurred in the last 3.5 years, 3 years, with the new leadership at FHFA is a focus on what they call mission-driven housing, which is affordable. And I think that secondary mission of Freddie Mac and Fannie Mae may drift away, regardless of whether or not it's private. I think that there's a chance that that mandate of driving affordable housing, capital A affordable, meaning tax credits and that sort of thing, becomes less important to those administrations under a Trump administration and under a privatization of those two institutions. So I think they're around. They're such a huge part of the system today. They're not going anywhere. They continue to do $50 to $70 billion a year in new origination, and they continue to underwrite exceptionally well. But I think it'll be nuanced if they're taken private.
Thanks, Tom. I'm going to take us home. Thank you, first of all, for your time, everyone. I'm going to answer a couple more questions, but I'll circle back. Mike asked a question. He has a significant capital gain in January. Do we have anything other than QOZ? Mike, the only other thing we have is 1031. So if the capital gain is coming from sale of real estate, we do have a 1031. We call it DST, Delaware Statutory Trust, that rolls into Income Plus. We have entered that market. We did our first one. It was a really amazing deal in Austin, and then we have two more tied up, one in Nashville and one in Charlotte. So we're going to have plenty of product for 1031 investors. If that's your gain is being generated from real estate, absolutely give us shoot me an email and we can discuss it if it's appropriate. If it isn't from real estate, no, then QOZ is the only thing that in the real estate space would be applicable to a sale of a business or stock or some other form of capital gain that's generated. Thanks for your question. Another question Gregory asked, thank you. I think his question is about, he's a QOZ Fund 2 investor. What do these trends that we're talking about portend for QOZ2? And generally it's bullish, Gregory. I'm talking about rent growth, which is going to improve, top line revenue at these properties. Dave touched on some of the expense side. We don't see shocks in insurance or the expense side to erode those revenue gains. So our net operating income should be going up as these projects move from development into renting and stabilization. And so it's a very bullish outlook, and I hope that came through. We don't like to be cheerleaders, but that is our opinion. Regina asked a question about Detroit as a target city. We don't cover Detroit. We don't actually invest anywhere in the Midwest, including Chicago. We don't invest there anymore either. We just don't feel like the growth rate is high enough relative to other cities. But that doesn't mean you won't find a good deal in Detroit. I just don't want to have consistent exposure there. I think that you're going to underperform the growth rate, and Multilytics, our machine learning sort of corroborates that. Matt asked a question about the Central Florida market. We're very bullish on Tampa in particular, Orlando as well, but I would say Tampa first, then Orlando, Jacksonville as well, but I would group both Orlando and Jacksonville behind Tampa. Those are the three markets we cover, so I won't speak to other markets in Florida. Aaron asked a question about Raleigh and our AI. I'm actually going to give this to you, Dave, because you live there, you breathe it. I know that you know this up and back.
Yeah, I mean, real quick answer to that. Raleigh's a laggard market, certainly to Charlotte. So we anticipate that being a late 25 recovery market, but showing some significant spikes in 26. So to be very specific, I think January of 25, we expect from January 25 to 26 for that full year, about 1.2% growth. And then from 26, the full year of 26, we expect 4.4%. So a very strong recovery in the outer years.
So last question, and then I'll send us off. Michael asked a question. I mentioned that I believe that the 10 years is in a range, and we're kind of at the middle of that range. So 2025 will kind of be 375 to 475. We're at 4.2 today. I haven't checked recently, but that's about right. Why? The question is why? Why don't we see debt yields coming down? Um, the why is I don't see inflation going down further. Inflation is kind of, depending on how you measure it, it's plus or minus 2.5. I actually think it has a better probability of going up than down from there. I think we're more probable to see 3 than 2, but I don't say that in an alarming way. I don't think we're going to 6. I'm not saying that. I just think that we're going to start being in a much more consolidated range, both in inflation and yields. And I don't think we're going to find that range is around 2. I think it's going to be more like between 2.5 and 3. And I stated why. And because the 10-year needs to be a spread that provides a real return to an investor, if I think the midpoint is kind of 275 and historically you needed 125 of a real return, you get to 4. It's kind of where we are. So like I actually believe that the 10-year note yield is pretty fairly priced right now. And so that's my opinion. It's a little counterintuitive because I know people hear a lot about the Fed cutting rates, but the Fed only can control the very front part of the curve. 30-day money, 60-day money, 90-day money, they can control that. But as you move out into time, they can't control the 10-year note yield. That's the future expectation of rates for 10 years. And that's what you've seen over the last 3 months, a steepening of the yield curve. The front end has come down, the back end has gone up. And so that actually indicates a much healthier economy, actually. We've gone from an inverted yield curve to kind of a flattish yield curve, but it's trending towards yield curve that's healthy. And what's interesting is we did that without a recession. Normally you have a recession when you have an inverted yield curve, and that really didn't happen. I know that I've gotten some feedback from some investors saying, no, you're being too hard on yourself. There was a recession. There was technically low growth for 2 quarters, et cetera. But the reality is there wasn't. There wasn't a real recession. And that's surprising to me. So I admitted that I was wrong about that. But part of the reason I believed that was going to happen is it was a deeply inverted yield curve. And by the way, it was the longest amount of time ever without a recession in measured history of what we're looking at. And so, yeah, it didn't happen. And I'm glad it didn't happen. Who wants a recession if you don't have to have it? Well, listen, I'm done. Thank you very much, first of all, Dave and Tom. I know you're very busy. Thank you for joining us. And
that was fun. Good to talk.
Yeah. No, you helped me, Tom and Dave. I don't like to talk that much. And so you helped me a lot. And secondly, thank you, first of all, everyone who joined, whether you're an investment partner or not. If you're a partner, thank you for being a partner. If you're not, we believe in sharing information to the market. Part of what we want to do is educate people about multifamily and about the economy and how it affects and relates, with the hopes that you'll make the best decisions that are appropriate for you. And so thank you for your time. And as always, we will be accountable and we'll judge these predictions in 12 months. Have a great day, everyone.